Nvidia on your list, Don. Let's talk about this one. I mean, shares are gaining some ground today, but it has really had a difficult year this year, even despite, how strong some of the fundamentals have been for this company. But talk to us about why this one is on your list.
Yeah, this one's actually on my list, but from a much larger perspective. First of all, yes, Nvidia is down quite considerably on a year-to-date basis. Nevertheless, look back to the last 5 years. So, Rick, it's something fairly spectacular because you're going to see that Nvidia for the last 5 years is up still almost 1,300%. Okay, it is the backbone behind the NASDAQ. And if the NASDAQ is going to still see some volatility, some sell-side activity, Nvidia is almost definitely in the crosshairs. So this next position is going to be bearish at this point. Again, up nearly 1,300% over the last 5 years. And I think Nvidia is in the perfect position right now to largely be disrupted. This is one there, you were just talking about, Diane, a moment ago, maybe the bottom line in here, some really solid fundamentals. But look, we've already seen the DeepSeek debacle. There's more to come. Other firms are building GPU that's going to be the equivalency of what NVIDIA is doing. So they're not going to be able to stand alone much longer. With that, again, I think this thing is going to continue to come in. I'm actually going to give myself a little duration in this trade. I'm going out to the June 20th expiration. I'm going to be buying a 94 put, selling an 84 put, looking for kind of a wild and woolly move to the downside. That is a $10 wide spread. Although in the near term, I think you can still see NVIDIA bounce. I think there's more sell side activity to come in the near months. This one is actually done for a $3.30 debit. Again, looking for a fairly significant move back even under 80.
Nvidia is now trading at a significantly lower rate than its 5-year average of 71.54 times projected profits at 24.45 times. Therefore, it is clear that the majority of the risks are already factored into the share price of the company. However, Nvidia also has a track record of recovering nicely from steep declines. This pattern can be better illustrated by a few recent occurrences. From its peak in early October to its trough in late December 2018, the stock fell 53%. The fall was mostly caused by the worldwide tech sell-off and the crypto market crisis, which led to Nvidia building up excess inventories. However, once inventory levels stabilized and sales in the data center and gaming categories began to show significant momentum, the stock recovered by more than 65% in 2019. The early phases of the COVID-19 pandemic caused supply chain issues and widespread market panic, forcing Nvidia's stock to plummet 30% from its previous high in February 2020 to its low in March. However, by March 2021, the stock had surged by more than 100% due to the pandemic's increased demand for gaming and data center services. Finally, worries about supply chain disruptions and rising interest rates caused Nvidia's stock to plummet about 66% between November 2021 and mid-October 2022. However, by October 2023, the stock had recovered more than 200% because to the company's emphasis on product innovation and the booming demand in the data center and AI markets. As a result, in the past, Nvidia has recovered even more quickly within a year, following a large price drop. In order to take advantage of this stock's potential for future growth, it makes sense for retail investors to purchase at least a small investment in it. The median 12-month target price set by Wall Street analysts suggests that just a small number of U.S. corporations now have a market worth above $1 trillion. Nvidia is currently worth $2.7 trillion. The median target price of $175 per share is a 58% increase from the current share price of $100. As of April 12th, Wall Street analysts believe that Nvidia is the best trillion-dollar stock to purchase. The median target price's implied 58% upside is 14 percentage points higher than that of Amazon, the next closest company. What investors should know about Nvidia is as follows. The graphics processing unit, GPU, which Nvidia invented, is its most well-known invention. Originally transforming computer visuals, such processors are now the industry standard for speeding up complicated data center tasks like artificial intelligence, AI. In the data center GPU and AI accelerator markets, Nvidia holds a market share of over 90% and 80% respectively. The company's unmatched software development platform, CUDA, which includes hundreds of code libraries, pre-trained models, and frameworks that simplify the development of AI applications for use cases ranging from recommender systems to generative AI tools, makes it extremely challenging to compete with. Additionally, Nvidia adds data center hardware such as networking devices, chip interconnects, and central processing units, CPUs, to its GPUs. Actually, Nvidia dominates the market for InfiniBand networking, which is the most often used connectivity option for artificial intelligence. According to CEO Jensen Huang, Nvidia is able to create data center systems with a superior total cost of ownership because of this vertical integration. So, what implications does this have for Nvidia's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on Nvidia stock in the comments. Your support truly helps us grow. Now, let's get back to the video.
Now, China's 125% tariffs on U.S. goods kicked in over the weekend after the White House imposed duties of 145% on Chinese imports. But Beijing also indicating that this would be the last time it matched the U.S. levies, calling President Trump's tariff strategy a joke, its words. China is now looking to consolidate its ties with other trading partners. President Xi Jinping is going to start a three-nation tour of Southeast Asia today, heading to Vietnam first before visiting Malaysia and Cambodia. But the Trump administration did soften its stance a little bit on Friday, exempting smartphones, PCs, and consumer electronics from the crippling tariffs, even if they are imported from China. So, at least initially, that gave Apple and Nvidia stock a boost on Friday. But here's the but and the rub. Shortly after that, President Trump warned that the reprieve would be temporary. This is on his social media post on Sunday, Truth Social, suggesting that tariffs on the tech products would likely fall under a separate category. So, Sherry Kang, I mean, this is really interesting, right? A little bit of give from the Trump administration. China says, look, 125, that's as much as we'll go. You do whatever you want. I'm getting on a plane and visiting my friends in Vietnam and Cambodia and also Malaysia.
Yeah, definitely. And I think Trump was definitely watching the headlines coming out of after, of course, a Friday. And it could look like he is blinking once again. It could look like he is pivoting, softening his stance on tariffs on China. And he doesn't want that, obviously, because he doesn't want the pressure to come off. It makes sense because he is in this negotiating mode, at least with the rest of the world, and not with China necessarily. But at the same time, just going back to that exception or exemption on some of the tech areas, he is mindful of consumer impact. He is thinking about market impact. So I think that is the biggest takeaway of Friday announcement of quote unquote exceptions.
Yeah, and it doesn't look like the U.S. and China are anywhere near getting ready for talks, right? And this is the problem. I think part of it at least is this sort of formatting, right? The White House and the Trump administration, they're pushing for, look, I want to call with Xi, make it happen. I want to call with Xi. The Chinese side is saying, look, before you even get to that phone call, much less a face-to-face summit with our president, our sub-leader level minions or officials, they need to meet and hash things out so that there's some sort of deal in place, because I think the greatest fear that China has is they saw what happened in the Oval Office with Trump and Zelensky. I mean, that's at this stage, that's the last thing they want to see on TV, right?
In recent months, Nvidia has faced two significant obstacles, but neither should ultimately cause the firm to fail. First, the market believed Nvidia's sales would decline as investments in AI infrastructure stalled when Chinese startup DeepSeek built complex, huge language models with significantly less processing power than American firms. However, that hasn't occurred. Rather, many analysts believe that more economical training methods would make AI accessible to more businesses, which will raise demand for Nvidia GPUs. Furthermore, according to CEO Jensen Huang, AI would need 100 times more processing power than was predicted just a year ago due to the development of robotics and reasoning models which use massive language models for complicated reasoning. The U.S. government's restrictions on chip exports are the second obstacle Nvidia is facing. On that front, however, investors just received some positive news. NPR reports that despite the escalating trade war, the Trump administration has decided not to outlaw the less potent H20 processors, even though Nvidia is unable to sell its most potent GPUs in China. In a larger book, generative AI is merely the most current chapter. In his keynote talk at Computex 2024, Jensen Huang declared that the next wave of AI has arrived. Physical AI-powered robotics will transform entire sectors. As autonomous machines grow more common, Nvidia is putting itself in a strong position to benefit from innovation in both hardware and software. The market for autonomous humanoids, which Citigroup estimates could be worth $1 trillion by 2040, will be accelerated by GRZ0T. Grandview Research projects that until 2030, spending on AI services, software, and hardware would rise by 35% yearly. Wall Street, meanwhile, projects that Nvidia's profits would rise by 38% a year through January of fiscal 2027. The current valuation of 37 times earnings appears low as a result. Purchasing a holding now should be easy for patient investors who plan to keep the stock for at least 3 years. To stay informed about the latest developments from Nvidia and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on Nvidia stock, so please share your opinions in the comments below. Now let's dive into today's video.
Okay. All right, then, even under 80. Wow, that's a bold call there. All right, Rick, take us through what the technicals look like for Nvidia.
So on this chart here, if we were to take it back a little bit further than 1 year, we would see that right about where we are now is the old highs from 2024, around 90, like around that general level here. It's just kind of just out of the view of this particular chart here, but you can see that there's heavy volume at this low area near 88, 90, around that point. You can also see our light green line matching up with that low from August 5th, a significant low point for so many stocks here. Recent price action forming a falling wedge type of shape here. We've fallen below all our moving averages. They're all trending downward. We've given up the volume profile point of control. RSI trending lower, out of the oversold area, but still not anywhere near that 50 midline that would suggest a shift to bullish momentum once again here. So I kind of see Doug's point here. If we start to break below 90 too far, there's not really a whole lot, it seems like, to break the fall. That would be a significant move below what was previously an important high water mark here. So if we were to move upward, though, green line represents some old low points, barring our rather anomalous August 5th low point there. For the most part, price stayed above that line near about 101.50 or so. So that could be a resistance area to consider.
The company's Chinese division, which accounted for about 13% of its revenues in fiscal 2025, ending January 26th, could suffer as Nvidia's best-selling H20 chip does not meet these requirements. Although other chip manufacturers are well behind in the artificial intelligence (AI) race, Nvidia is also facing pressure from the competition. The company's continuous ramp-up of its Blackwell systems is also putting short-term pressure on its gross margin. Notwithstanding these obstacles, a number of catalysts have the potential to raise Nvidia's stock price in the upcoming months. Given its more than 90% market share in AI GPUs, Nvidia has an unrivaled technological advantage in AI computing. The business has created a strong AI infrastructure that is tailored for a number of AI computational tasks with substantial room for expansion. These include inferencing, which includes sophisticated reasoning, post-training scaling, which involves modifying and improving underlying models, and pre-training scaling, which involves constructing and improving foundational models using substantial volumes of multimodal data. The newly released Blackwell architecture solutions are specifically designed for inference workloads that require real-time model deployment and operation across a variety of deployment settings, including cloud, hybrid, and on-premises. In comparison to the Hopper 100 chips, Blackwell exhibits a 25-fold increase in token throughput and a 20-fold reduction in cost, making it ideal for workloads involving computation-intensive reasoning inference. Therefore, Blackwell is anticipated to be a major growth driver for Nvidia as enterprise demand shifts away from training workloads and into more frequent inference workloads. With more than 5.9 million developers utilizing Compute Unified Device Architecture (CUDA) and other software platforms, Nvidia has established a strong software ecosystem in addition to hardware. In order to help businesses successfully use AI solutions, the company has also recently released software products, including NVIDIA AI Enterprise and NVIDIA Inference Microservices. The significant switching costs imposed by this software advantage have resulted in a loyal customer base. Lastly, Nvidia is finding that the quick uptake of robots and AI agents is a major development path. Because Blackwell chips have the processing capacity and low latency needed to create systems that can make intricate judgments and plans, they are well positioned to profit on the growing agentic AI opportunity. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
Yes, there's some good data built up we can rely on if we get positive news, any developments that are positive on the trade front. I think the 90 days was a breath of relief, if anything, sparked a short covering rally yesterday, but it also promises at least 3 more months of headlines that may go one direction or another. Some indecision. The biggest concern is that by drawing out the process, corporations are going to hold at bay any capital expenditure plans that might be on the margin. International producers, shippers may be on pause about making commitments to building capacity in the U.S. 3 months is a necessary step. The market was very oversold, very ready for anything that was a bit of relief, but we're still sort of lost in limbo until we get some better information. Frankly, we thought, and maybe a little too optimistically, we'd have much more clear progress by the end of June, which I think we still will, but has everything been put to bed at that point? Doubtful.
Okay, so I understand why that would mean more volatility in the months ahead, based on the fact that 90 days is just a pause. So I guess in one sense we might be kind of kicking the can down the road. But why haven't we reached the lows? Because I'm looking at an S&P 500 that's still down about 10% year to date. So why does it have to go lower? And what do you need to see to know that maybe a bottom has been reached?
Well, just from historic comparisons, looking at the PE ratio, say earnings on the S&P, for example, are 235 in that range. Not out of the realm of possibility that we see flat or even marginal down moves in 2025's total number. So if you're expecting say 225, let's make it a 5% sell-off or a 5% reduction in earnings, and historically speaking, you put a 17 multiple on that, you're still down around 4,000 on the S&P. Anything greater in terms of earnings downturn and a little bit tighter contraction on the multiple puts us in the mid 3,500 range. That's, I think, a bit extreme. Frankly, we see more value starting in the mid 4,000 range, about 4,600. Would be surprised if the situation really pushes the S&P below 4,000. I think despite the fact that we're playing hardball with these major trading partners, we have to be cognizant of the fact we don't want to do too much damage to the economy. And for better or for worse, and I think the long term it's worse, and it both supports the idea for bringing more productive capacity to the U.S., I think in a selective sense, certain industries that are important, where there's really value add and may have some security concerns. Some of the more basic productions, we can't give up the idea that international is probably the best price adjusted source for some of that. But going forward, we don't want to damage consumer psyche and the market so much so that we push ourselves into a deeper recession. I say, unfortunately, the top 10% of earners now, 50% of consumer spending. And whereas inflation wasn't really a problem for them in 2022, 23, the stock market takes a hit and money market rates drop, you'll see that segment of the economy will slow down purchases as well.
Okay, so if there's a greater than 50% chance of a recession, as the graphic was just reflecting your viewpoint, does 4,600 or 4,300, somewhere in that range that you were saying, reflect? Does that actually price in the recession that you're talking about?
It's fair. I think it's a fair evaluation. There's still so much up in the air in terms of just exactly what rate will be applied, tariffs to which countries, how the implementation plays out. Is it very industry specific? So many variables I wish I had a realistic handle on, but I think just based on more technical factors and trying to assume what the various thresholds for pain that the consumer and corporate America will be willing to put up with, and but the more importantly, what the government thinks is sort of the outer bounds of short-term pain that they'll willing to inflict. That should be, I think, certainly in the low 4,000s. I think that'll register.
Okay, so you obviously can't time the market, but what do you do between now and then? Are you putting any money to work right now as it relates to stocks, or are you buying bonds? We're seeing a sell-off in bonds once again right now.
Actually, yesterday we've been short stocks about 6% versus your typical 60-40 mix. Thought that we had certainly seen sufficiently oversold readings on the market yesterday, and the fact that it was April 9th and we basically thought something's coming. It'll be an announcement of some progress. Didn't think we're going to have specific deals that were going to be outlined, so at the very least, and also in keeping with previous comments from the president, there's the shock and awe approach that happens to begin with, and then there's the delay, give us time to work on the details. And certainly given the magnitude of the April 2nd proposal and the number of countries involved, there had to be some delay. April 9th wasn't going to be the final, not even, I don't think even any one particular country has ironed out the details, to my knowledge.
Yeah, so what'd you buy?
For the most part, a little bit in the information technology space. Those names seem to be depressed the most, but the allocation in general was really across the board, just a more top-down view than specific sectors. We continue to be about neutral weight in healthcare. That's done well, but the same in utilities. But communication services is one of our favorites at this point in time, and still slightly underweight technology. It's don't think we've seen the bottom there yet. Now, I will say the behavior in technology is beginning a little bit better with the recent lows. We tested below 5,000 on the S&P, rallied a bit, tested it again. Some of the information, the infotech companies we like, are holding up at higher levels, so there seems to be a little sentiment change there. So.
And what's on your list to buy once you see maybe some more of those red arrows that you're talking about?
Yeah, if we get a complete, let's call it, if a complete washout is in the 4,300 area, below 4,000 or 4,600, I think consumer discretionary names will be quite oversold. I know some of the airline stocks have suffered quite a bit. So those are areas where I think we'll bet on a snapback if we have a relief rally that actually marks the low, and we have some thought that this is now going to continue going forward. There's a better understanding of the tariff implications and possible plans and a runway to assume, or at least to build some estimates on earnings growth going forward, that some of those names most depressed in this sell-off, most of the marginal industries, we're not talking necessities, those will bounce back.